Hello people, welcome to the channel Free Management Education. Today we will discuss about the risk and uncertainty analysis in financial management, and this is the second part of the series and the final part also. So we will discuss about the sensitivity analysis, scenario analysis, simulation analysis and decision tree analysis. Okay, moving on. So at first, the sensitivity analysis is a way of analyzing change in the project's NPV or IRR for a given change in one of the variables. Again, I have made a separate videos on capital budgeting techniques like NPV, IRR, payback period, ARR, etc. I will add the link to the description box of my financial management and accounting playlist. So sensitivity analysis is a way of analyzing change in project's NPV for a given change in one of the variables. It indicates how sensitive a project's NPV is to change in particular variable. Suppose a particular variable changes in a project. Suppose the operations cost changes, then how the project's entire cost or project's um, benefit, the profit changes. Okay. The more sensitive the NPV, the more critical is the variable. Okay. For example, one may like to know whether a decline in the selling price by 10%, which managers may see as a distinct possibility, can be sustained by the project. That is, a decline in sell price by 10% can be sustained by the project. That is, can be tolerated by the project. If the project can bear such a decline in sell price. Okay. So here sell price is the variable, particular variable. If the sell price changes and if we need to see the NPV, the change in project's NPV, we can also see if the change in sell price affects the project's NPV or not. Okay. So the decision maker, while performing sensitivity analysis, computes the project's NPV for each forecast under three assumptions like pessimistic, expected and optimistic. Pessimistic is kind of negative attitude, expected and optimistic is kind of positive attitude. For example, what if the NPV, if the volume increases or decreases? So volume here is another variable. Then what is the NPV if the volume increases or decreases? Then what is the NPV if the variable or fixed cost increases or decreases? So variable or fixed cost is the variable here. Okay. So if for a small change in variable or fixed cost, NPV changes largely, then we would say that the variable or fixed cost is a critical variable. Okay. Because the change in NPV is much more dependent upon the variable or fixed cost than other variables. Again, what is the NPV if the project is delayed or outlay escalates or project's life is more or less than anticipated? Outlay here is the initial investment. Okay. So these are the various variables. So this is how the NPV changes if there is a change in variable. And sensitivity analysis is the way of analyzing the change in project's NPV for a given change in these variables. The higher the slope of NPV, the greater is the sensitivity of the project with respect to independent variable. So if this is the graph, and if the slope is much higher or like this, okay, then there is a greater sensitivity of the project. Now if the project is kind of like this, then there is very little slope. And again, if the project the line is horizontal, then there is no slope. Then that means the project's NPV does not change in the change in one of the dependent variables. Okay. So higher the slope, greater is the sensitivity. Okay, so this is another example, like a project is most sensitive to an increase in variable cost. So managers can focus their attention to control the variable cost. Okay, like they can enter into a long-term contract with the raw material suppliers to safeguard the interests of the firm and shareholders by not letting the NPV of the project slip into negative category. So the project can be most sensitive to variable costs, so the managers have to control the variable cost. If they are most sensitive to operation costs, then obviously the managers have to handle the operation cost much better in different ways. The disadvantages of sensitivity analysis are interrelationship of variables is not considered since only one variable is examined at a time. This means that if there is sell price and if there is suppose the variable cost, there can be relationship between them, right? There can be, if there is a change in variable cost, there also can be change in selling price too. But sensitivity analysis does not consider such relationship between selling price and variable cost. even they do not consider any interrelationship between these different variables. It only considers one variable at a time and how this one variable's change affects the project's NPV. It only considers this. So this is one of its disadvantages. Second is selection and quantum of change in the independent variable are purely discretionary and subjective to the manager conducting the sensitivity analysis. This means that it lies upon the manager's hand to select the variables, and also it entirely lies upon the manager's sense. Okay, so it is purely discretionary. It depends upon the manager how to conduct the sensitivity analysis, so it can be biased somehow. Okay, now comes the scenario analysis. So the scenario analysis is a tool that overcomes the limitations of the sensitivity analysis as the variables are strongly correlated with each other. Here the scenario analysis, it considers that the variables are strongly correlated with each other. That is, it considers the sale price can be correlated with the variable cost. Sale price have a relationship with variable cost. That is, it considers if there is a change in variable cost, there can be a change in sale price too. Okay. That is, a change in one variable is often linked with change in another variable. It is necessary to analyze the impact of changes in several parameters simultaneously. Okay, like taking different combinations. The simple sensitivity analysis assumes that variables are independent of each other, which I just mentioned. In practice, the variables will be interrelated and they may change in combination. Okay, like if there is operation cost and if there is sale price, we can measure the change in NPV because of these particular two variables, Okay, also we can choose the sale price and the variable cost. Also we can choose operation cost and variable cost. Like this we can use different combinations, and also they are called scenarios. These alternative combinations are called scenarios. Okay, one way to examine the risk of investment is to analyze the impact of alternative combinations, which I just mentioned, alternative combinations of variables called scenarios on the project's NPV. The scenario analysis measures the change in NPV of the project under different scenarios, changing several variables at a time because of interrelationship of variable among themselves. These are just the same lines repeated. I have just included them just to make the language easy and to make you understand better. Okay. It considers few combinations of variables and calculates NPV for each of them. Okay. So sensitivity or scenario analysis forces the decision maker to identify the underlying variables, obviously, which are the variables that affects the NPV most, indicates the critical variables, and helps in strengthening the project by pointing out its weak links. When you relate the different variables with the change in project's NPV, you understand that there can be some variables which does not affect the NPV at all. So that is the weak links, and also which is harmful for the projects. That is also a weak link. Its limitations are that it cannot handle a large number of interdependent and variables, and at times fails to give unambiguous results. Suppose there are 5 variables which are correlated with each other. That is, change in one also affects a change in the other 4. So at that time it fails to give correct result. Okay, so that is the scenario analysis. Now comes the simulation analysis. Here the Monte Carlo simulation or simulation analysis considers the interaction among variables and probabilities of the change in variables. It does not give project's NPV as a single number, rather it computes the probability distribution of NPV. It is an extension of scenario analysis. So in Monte Carlo simulations, we use the probability distribution of NPV. It is not a single number, but the probability distribution function. Okay. So it considers the interaction among variables like scenario analysis, and the probabilities of the change in variables, like if sale price can change in the next year and the probability is 20%, like that. Okay, so it calculates the does not give the project NPV as a single number, rather it computes the probability distribution of NPV. It is a computer based exercise that generates large number of situations. Okay, like scenario analysis, there are different combinations, but Here in simulation, there are a large number of situations and it can handle the relationship between the variables. And it computes the NPV for each of them to find out the distribution of NPV, its expected value, and the standard deviation as a measure of risk. Okay. So what is the risk from the standard? Okay. The scenario analysis assumes strong correlation among the exogenous variables, the variables actually, while simulation treats these variables as independent of each other. Okay, so it considers the interaction among variables, while simulation treats these variables as independent of each other. Sensitivity analysis considers only one variable at a time, which I mentioned, and therefore the interrelationship amongst variables is not recognized. These limitations are best overcome in simulation. Okay. The steps in simulation analysis: identify the variables that influence cash inflows and outflows. We also need to determine how each variable is related to NPV. Okay. These variables are normally demand, selling price, variable cost, initial investment, market size, market share. Okay. Now specify the formula that relate the variables, the relationship between the variables, like revenue depends on sales volume. Okay. And price. Sales volume is given by market size, share, and growth, like the relationship between sale price and variable cost. Indicate the probability distribution for each variable. Okay, like it is quite difficult to predict price or market growth with confidence, so we assign a probability distribution that this is the probability that this will happen or not. Now develop a computer program like linear programming, integer programming, okay, that randomly selects one value from the probability distribution of each variable and uses these values to calculate the project's NPV. The computer generates large number of such scenarios and calculates NPV and stores them. These stored values are printed and as a probability distribution of the project's NPV along with expected NPV and its standard deviation, which I just mentioned earlier. The risk-free rate should be used as a discount rate and it should reflect only the time value of money. If it does not consider the time value of money, then the project and then the analysis is not good. Obviously, you should consider the time value of money. That is, there are different annuity, there are different perpetuities, and various time value of money concepts. Okay. So these are the steps in simulation analysis. Now comes the decision tree analysis. It is a tool to arrive at a sequential decisions which involves series of decisions depending upon the happenings in the past and the earlier decisions taken. So it is a series of decisions which depends upon the past decisions. Okay. It breaks up the complex decisions into smaller decisions and calculates the NPV backwards to arrive at the most practical decision based on the maximization of NPV. So it breaks the complex decisions into smaller decisions and calculates the NPV backwards to arrive at the most practical decision. So at first you have to define the investment proposal. Why do you want to invest? Okay. And what is the initial cost and everything. Identify decision alternatives, like if you want to expand an existing market, you may choose to expand it in rural areas or metropolitan areas or some custom target groups, etc. Okay, so decision alternatives: where do you want to expand your market, or where do you want to invest? Then draw a decision tree. Okay, it should be graphed indicating decision points, chance events, and other data. I will draw a decision tree next. Okay. The relevant data such as projected cash flow, the probability distribution, what is the probability of this cash flow amount, etc. Expected net present value should be located on the decision tree branches. The results should be analyzed and best alternative should be selected. Okay. So this is a decision tree. Okay. So these are the points here. These are the decision points. Okay. So to draw a decision tree, branches from points marked with squares are used to denote different possible decisions. Okay. So where do you want to invest? In stocks, in mutual funds, in bonds. So this is a decision tree where the branches from the squares are denote different possible decisions, and branches from points marked with circles denote different possible outcomes. So these are the different possible outcomes. Okay. This is the probability 0.4. This is the probability declining 0.6. Okay. In a decision tree analysis, one has to work out the best decision at the second stage before one can choose the best first stage decision. So different stages of decisions are there. That is what it meant. So this is the decision tree. I hope this is clear up till now. If there is any doubt, feel free to comment. So this is the end of this video. So thanks for watching. Please do like, comment and subscribe to this channel for more updates. Okay. And my email ID is given in the description box. Do comment if you want some specific videos on some specific topics. Okay. Thank you. Stay safe. Take care of your family.